Welcome back to part two of the agnc analysis. We were jumping around here. Sorry about that. We were looking at the book value, and keep in mind the book value here we said was 1.7, and the any number over one, it's under one, is undervalued. And even though agnc is just slightly over one, it's still going to be it's close enough to be considered undervalued. I'd say it's still probably a good buy. Now, the price to book value, I don't know if I have the right numbers here. The price to book value, they should be between 1 and 3. However, I'm getting price numbers here, so I'm not sure if I'm doing my math right. If anyone has a better way or comment, or I'm sorry, if they have a better way to do this outside of share price divided by the book value per share, please let me know. I don't think I'm doing this right, so please don't go off my math here. Now, once again, the company share price or preferred shares, I was able to pull these up. Now, the dividends paid for them, they were using 8%. So we just use their company's preferred shares, and they were going for $25. So I just multiplied that by the 8%, and I pulled up their total earnings or total revenue, and we put it down here. And for that, we got $2. And the expected preferred dividends, I put down here. This allows you to get I'm sorry, give me 1 second. My dog's going excuse me, as Sammy, my German Shepherd. He's got a loud bark, doesn't he? So, this section here is where I was going to go over year growth, where we have the revenue for each quarter. Now, this is the upcoming quarter, and this is where I was going to try to go with the upcoming expected quarters low or estimated low expected revenue, so it doesn't flow nicely. I'll try to later on make the flow a little bit better. Now, the outstanding shares we did put in here, and I did add the initial outstanding shares with the weighted outstanding shares. So if you took out the year over year or the quarterly revenue, then this would have flowed great, which would have brought you to your EPS, or your estimated price per share, which is just your net income minus your preferred dividends with your weighted outstanding shares. Now, all you have to do, or all a company wants to do, is basically have the highest EPS. Now, this comes into when, excuse me 1 sec. I forgot the word I was looking for. So the EPS, this might be what confuses some people. When your EPS looks great, however, you don't have the your company has a great EPS. It beats what you're expecting. However, you don't um, you're not beating all the other companies. Well, that's might be why your company drops. You still want to beat all the other companies in your area. That's why you need to have not only a great EPS, but you still have to beat all the other companies in your area. Now, the reason I'm adding that other section is because I'm trying to get an estimated EPS and earnings. And for agnc, I figured that we're going to be looking at an EPS of 0.09. Now, it's still 6-7 weeks away. So this EPS, it's probably going to change, so don't rely too heavily on it. We have the initial net income for the previous quarter, the change in net income, so you can keep an eye on if the company is making money. And you can look at your initial EPS versus the previous EPS. And that's going to give you your growth rate, so you can see how much your company's grown from quarter to quarter. Now, you do want to know if the company's, of course, making money. Of course, the share price is going to reflect that. Hopefully, it's going to reflect that. This shows your outstanding shares, current to price, and how many outstanding shares that you initially had. So if the company is needing more money, they're going to sell more shares. We're going to scroll down here. So there's two different formulas we're going to use for the PEG ratio. This one allows you, if there's no preferred shares, it's just the price divided by outstanding shares divided by outstanding shares. And then this one is the price to earnings ratio divided by earnings gross ratio. Now, if you get 0 on one, then the other one works. Since agnc has preferred shares, this one is incorrect. This one would be the correct one. Now, you want to be above one is overvalued, so we're looking at an overvalued stock here. Now, earlier I said it was undervalued, so it's coming up on being overvalued. So like I said earlier, it was just a little bit overvalued. This is saying that its price earnings is going to be overvalued, so it's already starting to be overvalued. As earlier I said, in the 1 year time frame and the 52 weeks, it just hit its 1 year high. So you know it's just hitting that high mark where it's becoming overvalued. So this is potentially just there. So agnc is a red. It's in the NASDAQ, and it specializes in residential and commercialized. And the Yahoo says it's going to stop at 1663. NASDAQ says 1669. I am hitting that 10-minute mark, so I do want to thank you for stopping at all about stocks. Have a great day. Thank you.